Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, I'm going to make a very interesting claim right now, and I'm not sure whether you will agree with this claim or not. But I have observed that when it comes to investing, there is a difference between a smart stock picker and a smart investor. Now, a smart stock picker excels in analyzing a stock thoroughly. He's a bottom-up stock picker, and he'll go to great lengths in identifying a future multi-bagger. But this does not mean that he'll also be a smart investor. Uh, of course, he will have a few very good stocks in his portfolio. But what I've often seen is that at a portfolio level, when it comes to taking a look at the performance of his entire portfolio, he will not generate very good returns. His returns would be less than the market or market-like returns, even if he has a few winners in his portfolio. A smart investor, on the other hand, he may not have a lot of multi-baggers in his portfolio, but he has those 20-25 stocks in his portfolio that are consistent compounders that do well on a sustainable basis. And when you consider the portfolio as a whole, that portfolio is able to outperform the benchmark index. And a lot of people fail to make this transition from being a smart analyst, smart stock picker, to a smart investor. And if you have to do well in the stock market on a sustainable basis over the long term, it is my firm belief that you have to graduate from being a stock picker to a smart investor, where you have to have those key principles. You need to have that portfolio strategy that you can apply to pick stocks on a consistent basis, and do that year in and year out, and be able to put together a market beating portfolio, a portfolio that is able to consistently outperform the market over a 3 to 5 year period. So my goal in this session today is going to outline a few simple rules, a few simple principles that will help you make the transition from being a smart analyst, from being a smart stock picker, to someone who has a smart portfolio strategy, who is able to apply those rules to a portfolio of stocks and be able to consistently outperform the market. So that's my intention. And these simple principles and techniques, I have learned from legends like Benjamin Graham, the legends like Warren Buffett, whatever they have written. Whatever they have spoken about, I have tried to inculcate that, try to incorporate that into my own strategy, and the results for me personally have been encouraging. So I'll outline these simple principles and techniques that perhaps you can also use, when it comes to making the transition from stock picker to a smart, investor. So there are, at the core of any strategy, at the core of any stock picking strategy or a portfolio strategy, are three basic rules. You need to have a definite buy rule, a rule with which you're going to buy stocks. You need to have a definite, sell rule, the rule that you're going to use to sell the stocks, to move out of stocks, and you need to have a definite asset allocation rule. Moving your asset allocation between different asset classes. So once you have these three rules in place, and you follow them, I think there's a strong chance that you'll end up doing well in the stock market, and you'll be able to make that transition from stock picker to investor. Now, what is the rule number one? A definite buying rule. Now, as you would be aware that I'm a follower of the value investing style, value investing school of thought, and the critical components of any value investing strategy when buying stocks is intrinsic value and margin of safety. You need to buy stock, you need to know the intrinsic value of a stock, and you need to buy the stock at a small discount to their intrinsic value, so that you have sufficient margin of safety. Now, the problem with intrinsic value is it's an elusive concept, it's not definite, it's not precise. So that's the bad news. But the good news is that even if it's not definite, and even if the concept of intrinsic value is not precise, it is still mighty useful. See, just as you don't need to know the age of a woman to find out whether the woman is eligible for voting, or you don't need to know the exact weight of a person to know whether he's overweight or not. You don't need to know the exact intrinsic value of a company. You don't need to know the precise intrinsic value. You just need to know whether the market price is trading at sufficient discount to the intrinsic value, or the stock is trading at a premium to intrinsic value. Now, what I mean by this is, if a reasonable quality stock is trading at a single digit PE multiple, you know that the stock has a good chance of trading below its intrinsic value and it's undervalued. On the other hand, if a stock is decent quality stock is trading at a price to earnings multiple of 25-30 times, you know that in a majority of the cases that's not correct. The stock price of the company is trading more than the intrinsic value. Likewise, if a company is trading around its book value, a decent quality company, that has been in existence for 15-20 years, that's trading at close to its book value or below book value, you know that the stock is trading below its intrinsic value. And likewise, if the premium to book value is a lot, 200-300% premium, the stock is overvalued, it's trading above its intrinsic value. So the rule number one is try and understand the intrinsic value of a company and buy it at a discount to that intrinsic value. Now, the rule that personally I like to use is book value. So what I do is I try and recommend stocks which are trading at least 20% discount to the book value of the company. So the band that I like to use is between 0.3 and 0.8 times. So if the stock is trading at a price to book multiple of more than 3 times and less than 0.8 times, it's a strong candidate for me. The reason I don't consider stocks below 0.3 times book value, because I believe that it's too cheap and there's a strong chance that the company would be a value trap. So anything above 0.3 and less than 0.8 is what I consider, and below 0.3 is what I don't consider. Now, another buying rule that I use is try and ensure that the company has a strong balance sheet. One of the biggest reasons that company fail is because they have high debt on the balance sheet. So in order to ensure that the company has a strong balance sheet, I have another simple rule. The assets of the company should at least be 50% funded by equity, which what I mean by this is equity to total assets of the company should be 0.5 times or more. If this condition is satisfied, I know that the company has a strong balance sheet, because at least half or more than half of the company's assets are funded by equity. So an equity to assets ratio of 0.5 times or more and a price to earnings multiple of between 0.3 and 0.8 times is a buying rule that you can consider when you are buying stocks. You should build a portfolio of 25 to 30 such stocks, and you should invest in these stocks. Now, I had run some screens between 2014 and 20. The rules that I'm going to talk about today, I actually ran a value portfolio based on these rules just to see how it has performed in the stock market between 2014 and 2008-20. So we have this 6-7 years of performance to find out whether the strategy does indeed work in the stock market. And if I were to use the price to book value criteria and the equity to assets criteria, this is how a group of 30 stocks performed in the year 2014. So what you see on your screen right now are the list of those 30 stocks that have been selected based on the two buying rule that I have just discussed. As you can see, a lot of companies have been in the year 2014 have been two baggers. A lot of companies have gone up 40-50%. There are some like Everready Industries, which is I think 5th, 6th name on the list, which has gone up even 5 times in 2014. So the next slide is also the same. Since the numbers, the 30 companies were not fitting in one page, I just split the list. So the last row, as you can see, a group of 30 such stocks which was selected based on price to book value multiple between 0.3 and 0.0 times, an asset to equity ratio of 0.5 times or more, gave a returns of 80% in 2014. What I did was I bought these stocks on 31st December 2013. I sold them on 31st December 2014. 1 year period, 30 stocks, 80% returns. Now, another two criteria that I used was these companies should have at least a revenue of 100 crores in the latest financial year and should have a liquidity of at least rupees 1 million, average liquidity of at least rupees 1 million in the previous year. So the two valuation criteria, the revenue criteria of 100 crores and the liquidity criteria of 1 million, and that gave me a list of 30 stocks which was up an impressive 80% between 2014 and 2020. So that's the first rule, have a definite buying rule. The second rule is having a definite sell rule. Now this is very important. I think it's easy to buy stocks. It's easy to buy stocks based on certain valuation criteria, but it's very difficult to sell. So unless you know when you're going to sell, right when you're buying the stock, you will face a lot of difficulties in getting out of the stock, because human mind, I think, generates a lot of biases. A lot of biases can come in the way of intelligent stock picking if you're not, if you don't have a definite sell rule. So it's very important to have a definite sell rule in investing, so that you're able to, think with a clear head. You don't have a muddled thought process. Now the sell rule is for me was exit the stock after 1 year holding period. You hold the stock for 1 year, and after 12 months you exit the stock, irrespective of the returns that you've got. So even if the stock is up say 50%, 100%, you exit it. Even if it's down 30-40%, once you decide on a certain sell rule, you follow it, and you come out of the stock after 1 year. So that's the rule number 2 of any portfolio strategy. The first rule was a definite buy rule. The second rule was a definite sell rule. A third important rule is the asset allocation rule. Asset allocation rule, I mean, is your portfolio. What are you going to do for the entire corpus? Are you going to be 100% invested at all times, or are you going to switch between stocks and fixed deposits, or stocks and bonds based on some predetermined criteria? My personal preference is I'll never be 100% invested in stocks or never be 100% out of it. My personal preference is that I'll at least be 25% invested in stocks at all times, and at 25% invested in fixed deposits or bonds at all times. And for the remaining 50%, I'll take positions based on the market valuation. So what I have seen historically is that whenever the Sensex is traded at a price to earnings multiple of not more than 25-26 times, the next 1 to 2 years have not been that great for the stock market. And whenever it has traded at a price to earnings multiple of less than 25 times, it has been a decent time or a good time to be in the stock market from a 1 to 2 year perspective. So the rule that I follow is asset allocation rule that I follow is, at the end of every year, I'll see what the Sensex price to earnings multiple is. If it's greater than 25-26 times, I'll only be 25% in stocks and 75% in fixed deposits or bonds. And if the price to earnings multiple is, less than 25 times, I will be 75% in stocks and 25% in bonds. That's the rule that I like to follow, asset allocation rule of the allocation between stocks and bonds. Now let us see how this value portfolio would have done vis-a-vis the Sensex if you had followed these 3 simple rules: a buying rule of price to book value between 0.3 to 8 times, and asset to equity ratio of 0.5 or less. Selling rule, definite selling rule of exiting out of all the stocks after 1 year, irrespective of the gains or losses on them. And third, price to earnings multiple of Sensex if more than 25 times, you have only 25% in stocks. If less than 25 times, you have 75% in stocks and 25% in bonds. Now this is how the portfolio would have done between 2014 and 2020. As you can see, it's a pretty good performance. There has been outperformance in 2014, 2015, 16, 17 and 2020. So out of 7 years, the value portfolio, based on the 3 simples that I just highlighted, has been able to beat the benchmark index 5 of the last 7 years, which I think is a very good performance. In terms of rupees 100 invested, which you can see in the next slide, 100 rupees invested in the value portfolio based on the simple rules would have turned into rupees 313, a CAGR of 18% vis-a-vis the 12% CAGR earned by the Sensex. So that's a very decent outperformance, if you ask me, of a portfolio which is based on simple rules and running the portfolio. You don't need to put in a lot of hard work. Just a few hours every year you have to allocate to running the strategy, and despite that, it has been able to outperform the Sensex, the benchmark index by 1.5 times, giving 18% CAGR versus 12% CAGR by the benchmark index. So I think that's the beauty of following a strategy, a portfolio strategy, which is based on rules which are simple but effective, which have sound logic to them. If you would recollect all the rules, the outperformance of this strategy, I don't think it's fluke or it's a flash in the pan, because it had some very sound rules to it. It had a definite buy rule where you're buying stock below its intrinsic value, you're doing hardcore value investing. It had a definite sell rule where you're having a fixed rule of moving out of the stock so that you're not confused and you take the right decision at the right time. And you're also having the sound asset allocation rule where you're moving in and out of stocks based on the underlying valuation of the broader stock market. So if the market is undervalued, you're putting more money into stocks, and the market is overvalued, you're taking money out of stocks. So the rules, I think, are pretty logical. They have very strong logic to it. They are based on a proven approach to stock picking, which is value investing, and that's why I think you're seeing the performance that you're seeing, and you will see similar performance in the future as well. Now, before I leave, one last slide. I spoke about the principles, which you can see on the left side of the page of the slide. The three simple principles: buying a 100 rupee note at rupees 80 or lower, which means that you're buying below intrinsic value; a fixed selling rule, and you're having an allocation between stocks and bonds; and the rebalancing frequency, how frequently you rebalance the portfolio. So to the right are the techniques. It's not compulsory, it's not necessary that the techniques that I have used in running the value portfolio between 2014 and 2020, you have to use the same techniques. You can develop techniques of your own, or you can use the other techniques that I've highlighted. But as long as you are having a clear-cut strategy and you're following that strategy, I don't see any reason why you should not get a good performance out of your portfolio. So those are the different techniques that I've highlighted. Valuation criteria: you can use price to earnings, you can use dividend yield. Additional criteria: you can use debt to equity ratio if you don't want to use equity to total assets. Maybe you can use return ratios as well. But keep your criteria to a bare minimum, say 2 or 3 criteria max, and don't do khichdi out of it. Is what I would recommend. You have a fixed selling rule. Your rule does not necessarily have to be 1 year. It can be 2 years, or you can have rules based on upside also. Say you're selling the stock out after it has gone up 50%, you're investing the money in another stock, or you're selling the stock after it has gone up 100% and you're doing the same, investing the money in some other stock. Allocation between stocks and bonds: you don't have to be 75-25. If you want, you can be 50-50. Start the year with 50-50 allocation. End of the year, you again rebalance something which has become 75%, you move it back to 50%, and then again continue doing it. So it does not have to be 75-25 allocation, it can be 50-50 allocation. And the rebalancing frequency, I have used an annual rebalancing. You can do it quarterly, you can do it monthly, but I would recommend that you do it annually, which I think makes more sense. So these were the rules, the important rules that I thought would help you, make that important transition from being a smart stock picker or a smart analyst to a smart investor, a smart portfolio manager. These rules personally have helped me enormously in my own recommendation services that I run for Equity Master, and the results have also been pretty encouraging. So they are proven rules and proven strategies, and I think even you would benefit from it if you apply some of these rules to your own strategies. If your strategy you think are not giving the results that you intend. So as usual, I'll be waiting for your comments, your feedback, your likes on this video. Do let me know what you thought about this session that we had, whether these rules made any sense to you, or you thought they're not practically implementable. I'd be happy to listen to your views. So that's all from my side today. I'll see you again next time. Take care, stay happy. Thank you so much.